Rahul Chadda is joining us. He's a Market Master of the Day, Chief Investment Officer at Mirae Asset Global Investments. Rahul, great to have you with us here. Thank you very much for your time. Just wanted to understand your thought process as far as markets go and whether, how would you look at it? Is this a market waiting to kind of take out the previous highs and charge higher, or there is indecision and a bit of a pullback due now? What's your sense?
So we've been cautious on markets for the last 6 to 9 months, and we continue to have that view. Look, markets are going to be range bound at least for another 6 months. We've seen YTD. I was looking at the performances here. Look, Indian market has done its bit by falling the least amongst the regional pairs. In dollar terms, the market's down about 7% compared to, let's say, S&P, which is down 17%, HSCI, which is down 25%. So I think for next 6 9 months we would be range bound. It's only when markets get discomfort that the Fed's moved away from peak hawkishness to neutral and is becoming more dovish, and the same thing happens with policy making in India also, that the central bank moves from raising rates to neutral to probably cutting rates. That's where market multiples would increase. That's where markets would get excited in anticipation of a growth acceleration. But till now, it's going to be range bound. Yeah.
Okay, range bound. What about the rally, the phenomenal rally, Rahul, in the PSU banking space? Is it too late to enter now, or do you think that there's still more scope to go?
Look, again, if you look at the numbers, those numbers have been phenomenal. These names have not done anything for 10 years. So there was obviously a pent-up demand for this. These names were under-owned. Thankfully, we had some of these names about 2 years back, enjoyed the rally. Last couple of months, we were a bit kind of a circumspect here, and the reason was a bit worried on the macro front. We'd seen sharp drawdown in forex reserves. Thankfully, that pattern's been corrected in recent weeks. We've seen some bit of an increase in reserves. Again, bulk of our financials exposure would be still private banks. One would have some PSU banks, but these would be the leading PSU banks like SBI, some little exposure to BOB, etc.
Hi, Rahul. Morning. What about these new age themes? There's plenty of supply available. Are they exciting or?
Yeah, so themes may be exciting. The prices are not. So it's a buyer's market. One can wait for the supply to come and choose one's prices. To give you an example, look, something which we've been interested, we've added, is being the food delivery space, the likes of Zomato, where we've seen the company do a lot better in last 2 years in terms of gaining market share, etc. And one got good entry points when the supply came, where the stock was nearly down 30-40% from the IPO levels. So one can be opportunistic in these good companies, make sure that one builds position according to the price one is comfortable with. And on the other names, look, the supply is going to be there in plenty for next 6 9 months. So one can be patiently waiting, and wherever we get the comfort on price, I'm sure we'll add to our positions or build new positions in some of these names.
Rahul, banks and financials doing well, but the only thing is the consensus overweight, right? There's no great big surprise buyer who's going to come in incrementally. Maybe there is, we don't know. What's your sense? Yeah.
So absolutely. See, I think that's something well said. That look, most FIs own banks. So if they come to buy something in India, banks is something of first choice. But look, that's where again you'll get the earnings uplift also. So if some of these macro concerns recede, and to be fair, what we've seen in recent days is oil kind of go down rather than go up. So we are going into winter with oil more at 90 rather than 110. So that scare of 130, 140 oil, which we had beginning of this year, is a lot less. So if you keep that in mind, I think banks compound well, but the big money is going to be made once we get signs of growth acceleration in the economy. So that's where when some of these consumer names which have got beaten down would kind of a bounce back. That's when some of the cyclicals, like right now, nobody talks of metals, etc. But as the global growth bottoms and over next 12 months, as Fed moves from hawkish to neutral to a dovish tone, I think some of these cyclicals would provide much higher returns.
When you say cyclicals, do you also include some of these capital goods names in that, infrastructure? Because infrastructure hasn't performed for many years now. Do you think we are seeing a turn in the cycle?
So clearly, if we see the stock prices are saying so, if you look at the recent kind of a performance of these names, the multiples they're trading at record high multiples. So that is Clearly, market being excited of the potential for these names for the future. One has to see a pickup in the private sector capex. There is a little bit of an increase here and there, but not a broad base pickup in the private sector capex. But should that happen, I think infrastructure cycle can be a multi-year cycle, and this is a trend we believe is going to happen in the coming decade. That as reshoring happens, as manufacturing moves away from China, as countries want to take control of their strategic manufacturing, etc. I think the domestic cap goods companies are going to benefit from that.
Rahul, what about the IT space? Big debate out there, the big underperforming index of this year, but it had a splendid 2020 and 2021. Now, some of those stocks, particularly the large cap names, they're trading closer to around their 5-day PEs. Do you think that that's a good investment opportunity right now?
So I think that can be a good hiding place in the sense that if one is worried about rupee depreciation, one is worried about ballooning trade deficit, etc., these are a good hedge. From a valuation perspective, look, they're at fair valuation, anywhere between 18 to 20 times. Right now, it seems like US is going to have a soft landing. Look, it doesn't have those excesses of 2007, 2008. So it's not going to be a deep recession. If at all it happens in US next year, it's going to be more of a softer 1 or 2 quarters of weak growth. So that way, IT should do well. I mean, look, these stocks are going to grow their revenues at 7 to 10%. You have 3 to 4% dividend plus buyback yields, etc. So these are anywhere between your 12, 13% return stocks.
The other name is the other pack actually, which has done very well, Rahul, is entire defense, right? And now, at least in names like Mazagon, etc., you're seeing slight pullbacks. I mean, Mazagon stock is corrected 15% from its recent highs. HAL not so much. By the way, we have the management of HAL joining us next on the program. Any thoughts? Would you buy any of these names? If they are to be treated like capital goods stocks, I mean, same sort of sector classification, same genre, if I can use that word, the valuation gap is huge, right? I mean, ABB, Siemens, all these are trading at 70, 80 times earnings. These are still, 15, 16, 18 times earnings. Any thoughts?
So eventually these names are going to re-rate. I think there is some challenge which we have as ESG investors, that it's hard for us to invest in these companies which are into manufacture of arms, ammunition, etc. But look, with what we discussed before, with all these geopolitical tensions, with all this happening in terms of reshoring and looking to develop one's own strategic manufacturing domestically within the borders, I'm sure these names would have ample order books.
Okay. Well, one final word then from your end on the auto space, because over there as well, what we're seeing is there's a pickup in demand, but then there are some different trends, diverse trends. The global markets are still sulking. Two-wheelers have not recovered to their full capacity, while some of the other spaces are doing pretty well, like SUVs. What do you do here?
So we continue to like auto space. I think this is a space which has done well for us. And look, a good way to look at autos is what's happening. Autos today is what happened in smartphones 4 or 5 years back, where people used to be excited with the new features being introduced by the new range of smartphones. So that's happening in autos. If you look at this with what they've done with the entertainment systems and again the navigation system, there's a fair bit of an excitement in that space with all these hybrids being launched, with all these EVs being launched. There is pent-up demand which is coming through. There's a replacement cycle which is coming through. Even post-Diwali, the channel checks have been very positive on the space. So this is a space one would continue to buy on dips. And look, there was a worry on oil, but crude at 80 to 100 levels should be good for these names. So auto space is something one would like, and ideally one would like to be with companies who have a good EV lineup also, so that in next 4 or 5 years when the transition happens to EV, these companies at the forefront of that transition.
Okay, all right. Rahul, thanks so much for stopping by and filling us in with your quick take on markets and a whole host